Your Royal Highness, ladies and gentlemen, and honored guests. It is indeed an honor to be here today to talk about the role of the investment community in driving change towards sustainable capitalism. And my role here today is to offer you my perspective on 30 years of managing performance-based capital and overseeing a $150 billion global equity portfolio for one of the largest pension plans in the world. And during my time, during those years, I had the good fortune to see a plethora of global equity managers and international managers and investment processes. So I can say absolutely that as a practitioner, that investment firms do perform better with robust investment processes that incorporate modeling for non-financial factors such as responsible supply chain management, robust employee retention processes, and sustainable environmental practices, just to name a few. And this anecdotal observation is borne out by the Deutsche Bank research, which actually shows that sustainable investing using best-in-class investment processes do capture superior risk-adjusted returns. And in fact, 89% of the studies that were examined. So the consequence for an investment manager, an insurance company, or a pension plan of not incorporating such evidence in their investment process has critical implications for their competitiveness. Our challenge now is to make responsible investing and the integration of environmental, social, and governance factors mainstream rather than the exception to the rule. And while I'm here to discuss the progress of the investment community and what it has made towards this end in the last few years, I would first like to briefly discuss some of the challenges that the investment profession faces, then highlight some of the notable recent progress, and end with a few suggestions on how to accelerate thinking and the integration of sustainability factors in the investment community. And really, this is where we must start. It is with our thinking and our thought process in the investment community. On this point, a 6th century Chinese philosopher by the name of Lao Tzu understood the power of thought when he said, "Watch your thoughts, for they become words. Watch your words, for they become actions. Watch your actions, for they become habits. Watch your habits, for they become your character. Watch your character, for it becomes your destiny, and what we think we become." And so to begin, we must ask ourselves, what is it about the thinking in the investment community that has hindered the systematic inclusion of non-financial factors in investment processes? And I'd just briefly like to name a few of the challenges that I believe we face. First, I would say we have a legacy of decades of business school training where the theory of the firm is grounded in cash flows, return on invested capital, and shareholder value. All good things, seemingly. Yet this legacy does not systematically include sustainability factors and integrated thinking. To address this, I believe we need to inspire a new theory of the firm and academic rigor around quantification and disclosure in these areas of non-financial transparency. Second, accounting conventions and disclosure surrounding natural, intellectual, and human capital need to become more fully developed. There is still a lot of work to be done here, and to this point, we need to sharpen the analytical capabilities within investment firms to ensure that there are the requisite skills to analyze factors such as carbon pricing and climate change, for example. We cannot take for granted that the skills to incorporate ESG factors are currently resident in investment firms, because I believe in most firms they in fact are not. And the third item that I think is a challenge for the investment community is the legacy in many investment organizations to segregate ESG professionals from portfolio managers. And this is a real problem. We need to be sure that ESG professionals are included in the institution's key investment decisions and investment decision-making processes, and that the risk analysis of the ESG professional is an important factor in the investment decision, that they are included in the meetings with the portfolio companies rather than relegated to a subordinate role, which in many investment firms they are. With this said about our challenges, I'm pleased to report that there's some good progress on integration of non-financial factors at some of the largest investment management organizations in the world. Among the most promising developments is, in fact, the evolution from exclusion, screening, and divestment due to ESG purposes, which are associated with inferior performance for many years in the past, and evolving to an integration of ESG factors into the modeling of earnings. This, in and of itself, is a tremendous sign of progress. I would also next acknowledge that there is good leadership in certain parts of the world and lagging in others. You would notice that, in fact, Europe, South Africa, Australia, and some other countries, including Brazil, I would mention, some countries are further ahead in incorporating environmental, social, and governance factors into investment processes, contrasted, unfortunately, with that of the United States, which I believe lags significantly. Significant credit also goes to organizations such as the International Corporate Governance Network, which is based here in London. For their leadership, in 2007, they wrote the best practice guidance for investors in incorporating non-financial factors into investment management. The ICGN is an investor-led organization, which in fact has membership whose assets under management total 18 trillion US dollars. In their guidance, it states that it is the fiduciary duty of investors to take environmental, social, and governance factors into account, in addition to financial factors when making investment decisions. And as a follow-on to this, the European Commission awarded the ICGN, along with the PRI and the European Analyst Society, a grant to write curriculum and conduct investment training in ESG programs and ESG integration, and these classes are ongoing. Perhaps the most significant sign of progress in the last few years has come from the largest pension plans in the world that have actually demonstrated very strong leadership in ESG integration by forming a peer exchange to share and collaborate on best practice. These pension plans, there are 12 of them, and I will name them. They deserve recognition for their leadership. They are the APG of the Netherlands, Australian Super of Australia, the BT Pension Scheme of the UK, CalPERS in Florida from the United States, the Government Employees Pension Fund of South Africa, Norges Bank of Norway, Ontario Teachers of Canada, PGGM of the Netherlands, Previ of Brazil, TII-CREF of the US, and USS of the UK. Together, these 12 plans are responsible for roughly 3 trillion US dollars under management. And here are some of the highlights of some of their early stage progress. First, most of these funds have actually developed ESG policy themselves, which, believe it or not, is a new thing. And in addition to that, they have specific expectations of integration activities across all asset classes and are taking steps to integrate ESG training into all their staff. Secondly, these funds are consistently expanding the integration of ESG factors into external manager due diligence and contracting across all asset classes. Third, they are increasingly utilizing security analysis tools to incorporate ESG factors into the review of public equity and credit portfolios. Fourth, their engagement activities are expanding to asset classes other than public equity. And they are publicly disclosing more about their engagement activities, in addition to proxy voting. And lastly, there is a call on their behalf for more academic research that can support and accelerate the soundness surrounding the analysis and integration of ESG in financial modeling. In closing, I would like to advocate that more can be done at an overarching level that can support these integration efforts. And some of you in the room may be able to assist in this regard. This relates to leadership. My experience has been that when we get real organizational follow-through on ESG integration, this only happens when investment management organizations hire chief investment officers and chief executive officers that are completely committed to the integration of non-financial factors into investment processes. So we need more leadership among the governance bodies of investment management organizations, whose duty it is to hire these individuals, to hire the CEOs and the CIOs of these investment organizations. And it is only through that kind of leadership, not just at the highest level of the investment firm, but at the governance body that hires those individuals, which will force, I think, not so much force, but compel and drive the integration of ESG integration into these firms. Maybe some of you are in a position to affect that kind of change in this room. However, the call to action does not stop there. There is much that the CFOs of portfolio companies can do to accelerate the process with investors. CFOs can do more to communicate more effectively to investors about the strategy, their strategy for sustainable long-term value creation. Further, companies can move themselves closer to integrated thinking and integrated reporting. CFOs can and should communicate how they see sustainability as critical to their future success and how they view those drivers themselves. And lastly, CFOs can demand sustainability leadership in the management of their own company pension plans. One thing is clear. We know that these three segments of society, business, accounting and finance, and investment management organizations, are inextricably linked to moving the economy forward towards a more sustainable future. They all need to be brought forward together to develop a common language for reporting on the environment, social, and governance factors, and for that matter, integrated reporting in general. Investors need to be trained to integrate sustainability factors into the modeling. CFOs need to communicate the value of integrating sustainability into their businesses. And finally, accounting and finance communities need to work with standard setters to evolve reporting standards to meet this new environment. Effecting responsible change will require leadership on all of our parts. I thank Your Royal Highness for his leadership on sustainability, on bringing the accounting, business, finance, and investment communities together for the establishment of the International Integrated Reporting Council, in addition to the International Network and the UN Conference on Sustainable Development, among so many other leadership initiatives. We really need to evolve business, finance, accounting, and investment leadership thinking, because as Lao Tzu said, what we think, we will become. Thank you.